Ladies, gentlemen, we are diving down into 5 Canadian dividend stocks that all have really high yields, because I know many of you are chasing that juicy passive income, and that caught my attention because they recently dropped earnings. And these 5 stocks, of course, are going to be Telus, Enbridge, Hydro One, Fortis, and a recent utility ETF that just launched coming out of Horizons that is focused primarily just on the utility sector, yielding well over 4%. Now, if this is a conversation you can appreciate as much as I do, damn it, help the channel out, folks. Hit that like button, because let's start off with this telecom monopoly, because everyone knows Canada only has a handful of each of these giants in each given sector, and we got to kick it off with Telus, outperforming the S&P 500 this year, up 1.75% with a wicked yield of 4.47% here, folks. So let's get into this. For those of you that don't know, this conglomerate obviously primarily offers internet, cell phone services, and taking a look at that subscription connection growth in the crazy numbers here, guys, because for Q2 over last year, they saw an increase of mobile phone subscribers go up 4.3% to 9.4 million. Connected devices, guys, is up 15.2%. Internet up 6.9%. TV is up 4.3%. And the only segment that recently saw a little bit of a decline was residential voice, down 3.3%. Not sure exactly what that pertains to. And security, a smaller segment of their business, growing dramatically, 24.5%. Now, they also have a telehealth segment that's another growth aspect, but these are the primary income drivers. And my God, they're just crushing it on pretty much all facets here, folks, leading to an incredible operating revenue growth of 7.1%. And I find it very intriguing because their dividend year over year has also grown by 7.1%. I know that's what most of you fixate on, and this is a company that has done such a good job. They typically increase the dividend twice a year over the last 5 quarters, going from 0.316 cents to 0.3386 cents. Just fabulous, fabulous stuff. So, I'm going to continue to give Telus the thumbs up. And considering that Canada's population growth is explosive, because we're a smaller country that's getting a lot of immigration, and with only a few of these companies in each sector to go to, it's no surprise Telus is probably going to continue to perform just fine. Taking a look at Enbridge here, guys, North America's largest pipeline company, paying 6.14%, and also just recession-proof, crushing the indices, outperforming the S&P 500, up 13% this year. Fabulous, fabulous stuff. And this breaks down into a few segments, but most of their growth coming from liquid pipelines, gas transmission, and midstream. And we can see all of these have seen wicked growth. Take a look at this. Just in this last quarter, going from 1.84 billion in liquid pipelines to 2.095 billion, which is just insane. And gas and transmission, these are their 2 largest segments, but we can see they're also getting into renewable generation, which saw an increase from 113 million to 127 million. I mean, the gas and distribution is one of the only segments that saw a decline, and that decline, again, is incremental, very similar to Telus. I mean, it seems like all of these growth beasts in Canada tend to have one segment that's not doing that well, but across the adjusted EBITDA segment here, guys, 3.3 billion to 3.7 billion. But it is important to note that their entire sales here, guys, their total operating revenue going from 10.9 billion to 13 billion is incredible, but for some reason we saw an earnings per share decrease from 69 cents to 22 cents, and you're gonna have to do your own due diligence to figure out what caused this, because it had something to do with basically the commodity and gas distribution costs, which increased to $8.6 billion. So you're going to want to dive down and figure out what lowered their bottom line EPS. But considering the stock wasn't that hindered on this earnings and has actually continued to do very well, something tells me this is a controllable cost that probably isn't that impactful in the overall future of this company, which, if you're interested in the future of this company, they're basically looking by 2050 to get into biofuels, wind and solar, hydro, nuclear, gas, oil, and coal, and have this equally distributed across the revenue segments. But you can see, guys, now that the oil fundamentals are improving, even if oil kind of consolidates a bit here, this company knows that everyone is trying to bring oil back to the Western world and not have to focus so much on, Russia, some of these other foreign countries. So the pipelines are going to do well. I mean, their pipelines go all the way basically from Alberta to Texas. And this is just with the oil aspect. You can get into LNG, a ton of other stuff that they're focused on here, let alone the wind, solar. So this is a very stabilized company with incredible dividend growth as well. Basically, since their history from 1995, they've seen a 10% dividend GIGR. So the growth rate, very fabulous. fabulous. You're not going to go wrong here, right? This is a great kind of retirement stock. So let's kind of get more into the utility segment with Fortis, right? Now, Fortis, this company is flat on the year, which is still outperforming the S&P 500 with a 3.55% starting yield. This company, guys, again, 10 regulated utility businesses, 3.4 million electric and gas customers, 9,100 employees, 99% regulated utility assets, $29 billion market capitalization. It's really important to note that I'm only showing you the bread and butter, the premium of dividend stocks here in Canada. And from the utility segment, I don't think it gets much better than this, because this is a dividend focused company. And taking a look at revenues, guys, going from, what is this? We're talking about 2.1 billion from this time last year to 2.48 billion. Incredible growth again across their segments. Net earnings are up. Everything is just green, baby. And again, I love scrolling into Fortis's website, because the first and foremost thing they let you know is they're a dividend focused company, seeing a 6% average annual dividend growth guidance to 2025. So they are looking out for the next few years of seeing some pretty great dividend increases. This is highly segmented in Canada, with primarily being regulated utilities. So they have a very stabilized stream of income, because regulated is usually government infused. And their future capital plans here, guys, very similar to Enbridge. They're all looking to continue to diversifying across the segments, with clean energy investments making up 3.8 billion related to wind, solar, RNG, obviously primarily transmission and distribution making up about 63% of that total income, which is again absolutely incredible. Regulated utilities, you're never going to go wrong here. These are the guys that keep your hydro on, and Fortis being the largest market cap company, this is one that you just got to add to the list. I know the yield isn't high as things like Algonquin Power, etc., but when we're talking about long-term stabilized growth, this company just hasn't done any wrong, which leads me into the fourth stock here, being Hydro One, being a bit smaller cap, but still a conglomerate with $21 billion of value. This company is a little bit newer. It recently came public around 2015, 2016, when this was a government-owned utility. They spun it off, with the government still being one of the largest shareholders in the company, yielding 3.12%. Let's dive into this real quick, because this company has 30,000 circuit kilometers of transmission lines, highly fixated in Ontario, where I live. Hydro One is the company we pay here in my household, guys, when it comes to the utility and energy costs. It's the largest local distribution company in Ontario, with approximately 1.5 million customers combined. 2022 transmission and distribution rate base of $23.6 billion here, folks. Hydro One, I just find very intriguing, because the government is never going to go in the wrong direction. When the government's controlling something, as much as people like to criticize the government, when I look at the Canadian pension plan, I mean, they've outperformed the S&P 500. The government's been very good at controlling companies and getting growth, because it really comes down to their own bottom line. And we know most government officials or people related to government are working within these companies. So the total revenue went from $1.7 billion to $1.8 billion, which is just fabulous for the quarter here, guys. We can see transmission and distribution both saw increases across the board. So total revenues, you're not really going too wrong here. And from the dividend standpoint, this is another great dividend growth company. Basically, since their inception, if we scroll all the way back down from when they went public, they were paying about 21 cents a quarter to today, where they're paying about 27 cents or almost 28 cents. So rapid increase over the last 5 or 6 years, pretty healthy growth. And finally here, folks, when it comes to these utility companies, because that's basically what all these companies are, they're either infrastructure utility, telecom utility. It all kind of falls in line with this new ETF that recently launched that I've kind of found relatively intriguing. And I'm just waiting to see some of the performance metrics, because this is a monthly paying utility that launched from Horizon, the Horizon ETF company that trades on the TSE under UTIL. It's a $25 stock, and it doesn't really show a whole lot of data yet, because it really only launched August 10th and is already seeing some green across the board. But taking a look at the fact sheet here, it's primarily made up of 10 companies, being Pembina Pipeline, Enbridge, Hydro One, Brookfield Renewable Partners, Fortis, Brookfield Infrastructure Partners, TCE Energy, Algonquin Power, Emera, Rogers, Telus, and BCE, all relatively equally weighted. Now, usually I do not like these kind of compacted utility ETFs, because primarily it's just, again, it's so underexposed. You're kind of more inclined to buy these stocks individually and just pick the ones you like. But at the end of the day here, guys, my portfolio personally lacks in a few industries. One of those was being real estate. So I hold real estate individually. I do not have a lot of utility exposure. So I like looking at these infrastructure and utility companies. And this kind of ETF really represents all of them. So from a dividend income standpoint, just kind of taking a look at the fact sheet, the expense ratio is a little high at 0.5. Well, it's fairly high compared to something like a Vanguard. index, where you're usually paying about anywhere from 0.2 to literally 0.01 or 2, like a very low maintenance fees with Vanguard. But however, you're not really going to find such a focused ETF with such a high yield, right? So the current dividend yield apparently is 4.43%, which is higher than even basically almost all of the related ETFs within their directive space, whether it's energy, financial, utility. Communication services is the only one that goes higher than this, because communication with Telus, Bell, all yielding anywhere from 4 to 6% is no surprise. But you get a nice spread here, right? So minus out the 0.5% management fee, you're looking at almost an even 4% yield that's paid monthly. It's just a matter of, I needed to dig through this and do a little more homework to see how it's managed, because again, when you're looking at an equally weighted fund, it's great for income stabilization, but it's not good for growth, which is why I usually like my S&P 500 indexes, my VDY, my Vanguard Canadian index, which weights the stocks based off their market cap. So usually the larger market cap companies outperform. We've seen this with companies like Apple sitting at the top of the S&P 500 index. So you got to be a little careful with the way these are weighted. But if you're looking for income, and you want to diversify a risk, it might be worth paying the 0.5% management fee. But I want to pass that question off to you. Would you guys buy this infrastructure ETF, or again, just focus on these stocks individually, which are all incredible companies in their own facets? But let me know what you guys think. This has been a fun video focused on the Canadian utility and telecom sector that all recently posted earnings. So stay cool, stay awesome, and as always, I look forward to catching you in the next one.